Are you seeking a stable stream of cash flow to supplement your lifestyle, or are you willing to weather the storm of market volatility for the chance of substantial wealth accumulation? The answer to that question often points you towards one of these two powerful investment philosophies. Welcome back, fellow wealth builders. Today, we're diving deep into the age-old rivalry: dividend investing versus growth investing. We're not just going to scratch the surface. We're going to break down the mechanics, the pros, the cons, and ultimately, analyze which strategy holds the potential to make you more money in the long run. By the end of this video, you'll have a clearer understanding of which path aligns best with your financial goals and risk tolerance. So grab your notebook and let's get started. We've all seen the headlines. Some investors made a fortune overnight on a trendy tech stock, while others preach the slow and steady approach of blue-chip dividend payers. This brings us to a fundamental question in the world of investing. Which makes more money long-term? Dividend investing or growth investing? It's like the classic debate, tortoise versus hare. One promises reliable income, the other offers explosive potential. But in the long race for financial independence, which strategy ultimately crosses the finish line with the larger portfolio? Now let's see what dividend investing and growth investing really are. The dividend powerhouse. Let's first define our contenders. Dividend investing is the practice of investing in companies that regularly distribute a portion of their profits to shareholders in the form of dividends. These are typically established, mature companies that have a history of consistent profitability and a commitment to rewarding their shareholders. Imagine you own shares of a company like, mention a well-known dividend-paying company, e.g. Johnson & Johnson. Every quarter, for every share you own, the company deposits a certain amount of cash into your brokerage account. That's your dividend. It's like a rent payment on the stock you own. The primary objective here is to generate a reliable income stream. The growth rocket. On the other side of the ring, we have growth investing. This strategy focuses on investing in companies that have the potential for substantial growth in earnings and revenue. These companies are often in their early to middle stages of development and typically reinvest most, if not all, of their profits back into the business to fuel further expansion. In their early days, they weren't focused on paying dividends. They were focused on building gigafactories, expanding into new markets, and developing groundbreaking technologies. The goal of a growth investor is capital appreciation, selling the stock for a higher price than what they paid for it. The payout isn't through quarterly checks, it's through the appreciation of the stock price itself. So, in a nutshell, dividends offer you a paycheck now, while growth investing aims for a much larger lump sum later. Now, let's explore why someone would choose one over the other. Why are some investors drawn to the dividend side? Let's break down the primary advantages. In the next session, I will reveal which one of these strategies builds the most wealth, so hang around. The power of predictability. First and foremost is income. For retirees, or those approaching retirement, a steady stream of dividend payments can provide a reliable source of income to cover living expenses, reducing dependence on drawing down their principal. This predictability can be incredibly comforting during turbulent market periods. When the stock market is crashing, you might not want to sell your shares for a loss to cover your bills, but those dividend checks can keep coming in, providing a financial cushion. The dividend aristocrat shield. Second, dividend-paying companies tend to be more stable. To be able to pay a consistent and potentially increasing dividend, a company must have robust cash flow and a healthy business model. The companies with the longest track records of dividend growth are often called dividend aristocrats, or dividend kings, and they are renowned for their financial resilience, even during economic downturns. Examples of some well-known U.S. dividend-paying companies are Altria Group, MO, with the highest yield in the S&P 500, around 9%. Verizon Communications, VZ, major telecom provider with a dividend yield of around 6 to 7%. Pfizer, PFE, global pharmaceutical company with a 6% plus dividend yield. Lower volatility. Furthermore, dividend stocks often exhibit lower volatility compared to growth stocks. The income component can act as a floor for the stock price, providing a level of support that pure growth stocks lack. When the market turns sour, Investors often flock to the relative safety of established, dividend-paying companies, which can temper their decline. In short, dividend investing is about reducing risk and providing a steady cash flow. It's the investing equivalent of a reliable sedan, safe, comfortable, and gets you where you need to go with minimal drama. Now, let's switch gears and explore the arguments for growth investing. If dividends are the slow and steady route, growth is the potential-packed rocket ride. In the next paragraphy, I will reveal which one of these strategies builds the most wealth, so hang around. The power of compound interest. The fundamental driver of growth investing is capital appreciation, fueled by the incredible power of compound interest. Let's imagine you invest in a company that grows at an average annual rate of 15%. Over 10 years, that investment won't just increase by 150%. It will appreciate significantly more due to compounding. Your earnings in one year generate further earnings in the next, leading to exponential growth over the long term. The magic of reinvestment. Unlike dividend-paying companies that distribute their profits, growth companies take that cash and plow it back into research and development, marketing, acquisition, and expansion. This constant reinvestment allows them to innovate faster, capture market share, and theoretically increase their future earnings potential significantly. The hope is that this reinvestment translates into a much larger future stock price. The home run potential. Growth investing holds the allure of hitting a financial home run. While many growth stocks may not pan out, catching one Amazon or Apple early in its growth phase can lead to life-altering gains. The potential upside of a successful growth stock can far outweigh the consistent yet often modest gains from dividend stocks. Growth investing is about accepting higher short-term risk in exchange for the possibility of significant long-term capital gains. It's the high-performance sports car. Thrilling, potentially faster, but requiring more careful driving and a greater tolerance for a bumpy ride. Now, the moment you've been waiting for. Which of these strategies will ultimately make you more money in the long run? The unfortunate answer: it depends. Here's the truth. Neither strategy is universally superior. The better strategy depends heavily on your individual circumstances, goals, and risk tolerance. Let's look at the crucial factors to consider. 1. Time horizon. If you are young and have decades to let your investments grow, the growth investing strategy, with its higher volatility but greater potential for capital appreciation, has historically provided higher long-term returns. The ability to compound high growth rates over a long period can create substantial wealth. However, if you are nearing retirement or need income from your portfolio to support your lifestyle, the predictability and income stream of dividend investing might be a much better fit. You have less time to recover from significant market downturns, making capital preservation a higher priority. 2. Risk tolerance. Are you the type of investor who gets a stomachache every time the market drops by 5%? If so, the high volatility of growth stocks might not be for you. The relative stability and income stream of dividend stocks can provide peace of mind during market corrections. If you can handle significant swings in your portfolio's value and are confident in your long-term thesis, growth investing might align better with your psychological makeup. The temporary downturns can even be seen as opportunities to buy more shares at a discount. So, is it strictly an either-or choice? Not necessarily. Many investors adopt a hybrid approach, often called total return investing. This strategy aims to capture the benefits of both worlds: the consistent income and lower volatility of dividend stocks, combined with the capital appreciation potential of growth stocks. You could achieve this by allocating a certain percentage of your portfolio to dividend stocks and another to growth stocks. This might look like 60% dividend stocks and 40% growth stocks, depending on your age and goals. Investing in total market ETFs, which hold both dividend-paying and growth companies. Focusing on dividend growth stocks. These are companies that pay a dividend but also have strong growth prospects and a commitment to increasing that dividend over time. By diversifying, you can smooth out the volatility of a pure growth portfolio while still having exposure to companies with high growth potential. The final verdict. Ultimately, the most money-making strategy is the one that you can stick with for the long term. A well-diversified portfolio, whether it leans towards dividend income, growth potential, or is a mix of both, is key. The real enemy of long-term investing success isn't typically the specific strategy you choose, but rather emotional decision-making, high fees, and a lack of patience. So, which will it be for you? The reliable path of dividends or the exciting potential of growth? Or perhaps, like many successful investors, you'll find your perfect balance. Thanks for watching, and remember, the journey to financial freedom is a marathon, not a sprint. Take the time to understand your goals, define your risk tolerance, and choose a path that helps you achieve your dreams. We'll see you in the next video. And now that you understand the powerful difference between dividend and growth investing, you might be wondering, okay, but how do I really harness the power of dividends to build that wealth even faster? We've got you covered. In our next videos, we're going to unveil a simple, automated strategy that can supercharge your dividend investing. We'll deep dive into the smart dividend reinvestment strategy that builds wealth faster. Drip explained. You don't want to miss this secret weapon that can truly accelerate your journey to financial freedom. Click the link on the screen or in the description to watch it right now, and learn how to make your money work even harder for you. Don't forget to like this video if you found it helpful and subscribe for more wealth-building strategies. Thanks again, and happy investing!